Okay. Look like we're going to have to start this over again. I'm sorry I had YouTube muted. My name is Larry Hughes, real estate and mortgage broker. And today we're talking about uh, real estate questions. One of the main topic, again, you see me looking at two cameras, one Instagram, one YouTube. One of the main topics is Bank of America, how they set the real estate world on fire as far as news wise. Um, and when they announced that they have a 0%, 100%, 0% down payment home loan program that they will be releasing pretty soon. So those cities that they're going to release them to is five of them. They are Charlotte, Dallas, Detroit, LA, and Miami. Those are the first set of cities that are going to get this program, and it's going to be released to other cities in 2023. But for right now, Bank of America releasing a zero down payment, zero MI no closing cost program to be released in those five cities. Again, so those are a couple of details, right? Those five cities: Charlotte, Dallas, Detroit, LA, Miami. No mortgage insurance, no minimum credit score. So, from what I am understanding from the press release on bankofamerica.com, that they're not going to use the a credit score model. They're going to look at how you pay your other bills, such as your rent, your car note, your utilities, to establish your credit worthiness. And then they're going to go from there. Some of the questions that I would like answered that are not yet have been are available or have not been revealed is what is the debt to income ratio, max debt to income ratio? How about max loan amount or max purchase price? What are the actual areas of that the program covers in Los Angeles? Is it going by census tract, etc.? What areas is it going to cover? I know that they're targeting black and brown areas, but what specifically, where are they drawing the line, the red line, so to speak, in those areas? Uh, I've heard from a number of people who commented on this is that you don't have to be black or brown to get this program, but you have to be buying in those predominantly black or brown areas. Again, what is the max income level if there is one? What's the max purchase price, loan amount? Is it going to be a silent second? Is it going to be a debt to be paid off back at the end of 30 years? Is it going to be a grant, a forgivable grant? How many years do you have to live in a property if it is going to be a grant for when it's going to be forgiven? Um, what property types are going to allow? Is it just single family only? Or is it single family duplex? Is it single family duplex, triplex, and quads? Those questions will come out soon when they release the program fully in the targeted cities to test out the program. But so I'm going to reserve my judgment for that time when when that comes about. So if you have any questions, feel free to drop them down in the chat, guys. Feel free to drop them down in the chat. I love to get to them. Hey, Lanisha. Yeah, this program is coming out very soon. So I would like to hear more about it because, believe it or not, there are other 0% down payment programs or 100% down payment programs out there that can help you. CalHFA has one. That's calhfa.ca.gov. calhfa.ca.gov. That is a program that can help you. You can't go to them directly. You can just go there and read about the program, but you have to go through someone like myself, or a mortgage broker who has a lender who can place you in that program. But okay, Lanisha, you ready? I'll make sure I call you. Is your number still the same? But yeah, those programs. Wow, those programs are out there. Excuse me, I just heard some LA noise, if you know what I mean. Those programs are out there, um, such as the Chinoa program, the CalHFA program. There's a few other programs that can help you when it's time to purchase a home. Um, they do have all the details available as far as what your max debt to income ratio is, what's the max purchase price, what property types there are, what areas like Cal HAFA. It is a California program, so all of California is eligible. Those details are available, but it's only it's if you fit into that box, right? Once you sit down with someone like me, who will be able to look at your income, your debts, see if you actually fit in that box, and let you know the actual interest rates, what the if it's a grant, if it's a loan, a solid second, is that loan going to be on for the life of the loan? All those details you would have to know to make a decision on whether you like this program or not, or if this program is for you or not. And when Bank of America's program come out, then we'll see if there is viable, because there's sometimes have programs out there not even viable because the debt to income ratios or the purchase price limits. They're thinking, different purchase, right? We're in California, Los Angeles, our purchase price are kind of high, right? So it has to fit for us. So we'll see when those details come out if if it's worthy or viable for us here in Southern California. Some of the other stuff I wanted to talk about real quickly is the loan limits, right? What are the loan limits in Southern California or in a lot of the nation? If you see behind me, I wrote them down as conforming and high cost. In Southern California, we're a high cost area, right? So the conforming loan amounts for a single family is $647,200, but it can go up to $970,800. So now anything $647,200 and below is considered conforming and carries a lower interest rate than high cost. So we can go up to $970,800 on a single family, and that's for FHA, VA, and conventional. Well, let's leave out VA because VA has no limit, but FHA, conventional, those are the limits for a single family. For a duplex, $828,700 is the conforming rate, but you can go up to $1.243 million, but it carries a slightly higher interest rate because it's a high cost. For a triplex, 1.1. Let's get better up the rate. 1.1 up to 1.502 on the high cost. For a 4-unit program on a conforming, as for FHA, VA, and conventional, 1.244 up to 1.867. So the rates are, the loan amounts are here. These are the max loan amounts you can go. I'm sure you can find a triplex or a quad for less than those amounts, and start to use some create some generational wealth. So you may think, why would I buy, or how could I think I can afford to qualify for a triplex at $1 million or quad at 1.24, much less the high cost area, the high cost amount? Well, what you may not be aware of is that for 3 and 4 units, both of these programs we call it Fannie Mae and FHA, allow you to use a portion of the rents to help you qualify on paper. So let's go with FHA. FHA says we'll use 75% of the current, or market rents of the property. So 75% of the current or market. So currently, if you have tenants in 3 of the 4 units and they're bringing in $1,000 each, FHA says we'll give you $750 each to add to your income on paper. All right, so what is that? 2250. All right, so that's 2250 per month to add to your income. Now, conventional, there are certain situations where they'll also do the 75%, but there are certain situations where they will let you use the whole 100% of the current or market income of the units. Now, what do I mean by market? So if you're in a situation where you are able to get a property that is vacant, that you say a 4-unit, 3-unit property that has no renters, you can set the rent yourself, right? So there's nothing for the appraiser to compare by except they'll do what's called a rental survey. When this whole balancing act of appraisal happens, they'll do a rental survey of the area and find out how much of the market rents. And then based on that rental survey, they'll give you those market rents. Now, you can say the rents are $2,200 if you want. However, it's up to the appraiser and what he says the rents for the area is going for. He or she, because there are some female appraisers who are very good at what they do. So, with that being said, it is possible for you to purchase 3 and 4 units, even though what you're doing is buying money at that point, because you're buying a business. If you have 3 and 4 units, you're buying a business because you're in a business of renting property or renting space. And sometimes it can work out where you have dramatically reduced your income, or excuse me, your responsibility, because your tenants are paying down your mortgage. Although FHA on paper and conventional on paper says that you can, they're going to use 75% going towards your income. That's 100% in your pocket of reality, right? So we're just talking about on paper to help you qualify, but in reality, you're getting 100% of those rents and to help you qualify. FHA has one more thing that you have to do when buying 3 and 4 units. A couple of things I should say. You're going to need 6 months PITI for reserves. What is PITI? Principal, interest, taxes, and insurance. So if all that adds up to $3,500, you need 6 months times that. You need 6 months of that in a bank, in a mutual fund, something that you can grab, right? Something you can grab, and so they want you to have that. Another thing that FHA requires from the property, not from you, is that, like I said before, you had those rentals coming in at $1,000 a month. You had 3 of them, and you're going to live in one yourself. So your contribution is $1,000, right? So all total, that's $4,000. That's what the rent's bringing in, are $4,000, including the unit that you must occupy. Remember, FHA is not a first-time home buyer program. It is a program that it has a home occupancy requirement, but it's not a first-time home buyer program. So with this next test about the property, I don't want to get off subject. The next test about the property is that the FHA has something called a self-sufficiency test, or SST for short, self-sufficiency test. And it states that the rents that come in must be greater than or equal to your PITI. So these are the rents, and they must be greater than or equal to your PITI, principal, interest, taxes, and insurance. If that is achieved, then the property passes the FHA self-sufficiency test. So again, to recap, FHA requires when you're buying 3 and 4 units, have 6 months of PITI in reserves. It can be in a bank account. It could be in a any type of investment account, as long as you're able to pull it, right? And it must pass the self-sufficiency test, or SST, which states that the rents that come in must be equal to or greater than the PITI for the property past the FHA self-sufficiency test. So those are some of the things that I wanted to cover here today. And if you guys have any questions, I'd love to take them. I know it's late here. I wanted to test out my new AT&T high-speed fiber optics they just installed in my area. Before, my speed was very, very low. I don't know if you know anything about internet speed. The upload speed to upload video was less than 100. Now I'm at 900 megs per second, I guess we want to say. So I'm going to test this out. It doesn't work too much well on the phone, but it works well for the camera here. It's going straight to YouTube. Okay, what else? I touched on a little bit of VA. Some of the things about veterans I wanted to clear up for people. People know this, but some people don't. About veterans, I'm going to erase this crap here. VA home loans, a very good place, a very good program. VA home loans. So what's great about VA home loans? They have 100% financing, which means zero down. If you know anything about VA home loans, you know you must have served in the military and you've been honorably discharged, and you now have access to this benefit. 100% financing, zero down, zero mortgage insurance. VA home loans have zero mortgage insurance. They have low rates, lower than FHA, lower than conventional, lower than Fannie Mae, Freddie Mac, all those rates. They are the lowest rates because the Veteran Administration guarantees the loan from loss up to 25%. So Veteran Administration does not lend money. It guarantees the loan, like FHA insures the loan, but the Veteran Administration guarantees the lender of the loan from loss up to 25%. That is why you have low rates, and these loans are more easier to get because they also don't go on debt to income ratio. They have a special way when they look at the debt to income ratio. They say that if for a single loan veteran, if they have, let's say, I believe the number is nine. Don't quote me on this. $995 amount, $995 after their bills. They can probably go up to 75% of their debt to income ratio, which is a lot higher than conventional FHA, etc. So, and there's no loan limit for VA, but you must qualify using these guidelines. So VA is a very attractive mortgage program, and if you know a veteran who has not used this program, then you absolutely need to inform them that this program is out there and great for them. That's the VA home loan program. Rates are phenomenal. They have 30-year fixes, 15-year fixes. They even have adjustable home loans, but most veterans choose the 30-year fix and be done with it. One of the great things about a veteran, if you have, well, let me not erase this. If you already have a VA home loan right now, currently, they allow you to do up to 100% cash out. Cash out refinance. Let's say, for instance, you've bought your program, your home 15 years ago. You've seen rates, or excuse me, your property adjust or depreciation go sky high. You bought your property for $400,000, but now your property is worth $800,000, and you're going to pull some of that equity, which is about $400,000 out. You can do that as long as you qualify. You can pull up to 100% of the equity out. Comparatively, FHA only allows 85%. Period. Now, conventional, you can pull up to 80%, but FHA allows 85%. So you see the difference when it comes to FHA or VA. VA has a lot more there's a lot more attractive returns. Any questions here? Please let me know. Please let me know. I love to answer any questions. But again, I'm just testing this. I'm just testing my high-speed internet. Great. So that's that. So let's talk about another program that you may or may not have heard of. It's called the 2-1 buy down. Now, this program just has been released, but it's not an old program. A 2-1 buy down is a program that allows a home buyer to decrease their interest rates by 2% the first year and 1% the second year, returning to full strength on the third year. So let's see. What do I mean by that? For instance, let's say if you qualify for an interest rate of 4.875 on a 30-year fix, and conventional FHA, you pick, it doesn't matter, 4.875 on the first 12 months of payments. So 12 months, you're going to pay an interest rate. You're going to pay your payment based on a 2.875. So first 12 months at 2.875. Now, what is that payment? That depends on a number of factors, right? That depends on how much is your loan amount, what insurance you chose, what's your tax base. But with the 2-1 buy down for the first 12 months, you get a 2% discount on the interest rate. 2%. So hence 4.875 to the 2.875 for the first 12 months. Now, /1, right? You get for the next, what the 1 means in this equation is for the next 12 months. So month 13 to 24, which is the next calendar year, your interest rate is not 4.875, which is the qualifying rate. It's 3.875, right? Again, what is that payment? I don't know because I don't know your actual loan amount. Excuse me, your loan amount, what's your tax base, etc. But that's what this program is in. So first 12 months, you're going to take a 2% discount. So for your interest rate from 4.875 to 2.875. From the next 12 months, from month 13 to 24, you're going to go down from the 4.875, 1% to 3.875. And then month 25, all bets are off. You got that 24-month break in payment. Now you're at the full 4.875% interest rate all the way out to 30 years. So it is a fixed program with a benefit to having the first 24 months at a discount interest rate. For the first 2 years. No prepaid penalty. So let's say rates magically drop from the 4.875 down to the low 2s again, like we saw in the pandemic. You can refinance at any time. So there's no prepaid penalty, even in when you're in this, if you're in the first year, you're in the second year, you can refinance. It's totally up to you. It's a great program. This program is seller funded. It's only for purchases. It's seller funded, meaning that it has to be a seller concession only. What happens is the seller pays the difference between the 4.875 and the 2.875 in the first 12 months. And then for the next 12 months, they pay the difference between the 3.875 and the 4.875 in the form of a seller concession of the actual purchase contract. So if you're working with a realtor and a loan officer, they have to be fully in line and fully mesh to get this done. But it's a seller funded deal only. Again, this is not a new program. This program was out when I first started in the business in 2005. It just went away. But since now homes are sitting just a little bit longer, they're trying to entice more buyers into buying a home. And this is a seller funded option that some sellers or all sellers could offer the prospective home buyers to purchase their home if they're going to give them a break. And it's thousands of dollars, guys. When this breaks down, I've seen an example. I've run through examples where it'll save a prospective home buyer $16,000. Again, it all depends on what your interest rate is, what your loan amount is, and up the scale. But I've seen it where you can save a prospective home buyer $16,000 over the 2-year period. Now that's huge, guys. That's hundreds and hundreds of dollars a month off your mortgage that can help you transition into home ownership, because you may, all the things that come with home ownership, people that they don't know. A lot of home buyers don't know all the things that come with home ownership. You want to change this, you want to change that. Things come up. You're now paying water bill that you weren't paying before because you were living in an apartment. little things you want to fix on the house. So a lot of stuff, unexpected bills when it comes to home ownership. But those are the things that happen for the 2-1 buy down, which one of the things I'm going to talk about briefly, and they're going to end this live, is that when you purchase a property, guys, one of the things that I see not being explained enough is something called a supplemental tax bill. So mostly 98% of the people are going to make a payment, and it's going to be your PITI, meaning your principal, interest, taxes, and insurance, all included in one monthly payment. Right? So since you know that your taxes and insurance is included in your monthly payment, when you first purchase a property, you're going to get a tax bill. And it's going to say the supplemental tax bill. And you're going to think, most home buyers think, oh, I don't owe this. It's not my bill. My taxes and insurance included in my monthly payment. Now, this supplemental tax bill is a one-time only bill that you must pay. A one-time only tax bill that you must pay. And I'm going to try to explain it to you briefly on what that is. So when you buy a property, well, let me just take a step back. Taxes work like this. Taxes work are based on the actual assessed value of the property. There's an office called the Office of the Assessor, in which they assess the property at a certain value. Each county sets the tax base or tax rate based on the actual value. So for argument's sake, LA County tax rate, LA County tax rate cannot exceed, LA County tax rate is 1%. Plus direct assessments. Now, what are direct assessments? Those are things you vote on for your city, right? So every county has a lot of different cities in it. However, the rule is that the tax rate cannot exceed 1.25%. So direct assessments can't be no more than 0.25%. So because your LA County tax rate cannot exceed 1.25%. So what happens is LA County, we're talking about the supplemental tax bill. LA County is their year is not a calendar year. Calendar year is January through December, right? Well, LA County is something called a fiscal year. Their year starts July through June of the next year. So July 1st through June 30th. That is LA County's fiscal year. If I can spell right. Now you bought your property, and let's say you bought your property in August. Excuse me. You bought your property of August of 2020. And so now you're not going to own it for the whole year, right? You're going to own it for a portion of the year. So they're going to send you a tax bill that is the difference between the old value of the property of the purchase you bought it from. Let's say the old value was set at $350 and you bought it for $650. They're going to send you a tax bill based on the difference between the old value and the new value of the time of the year that you purchased it at. Again, from August through July. August, what did I say? July 1st to June. August through August through July of the next year. August through June, excuse me. August through June of the next year. That's going to, so you're going to go from August through June. You're going to receive a tax bill from the difference between those two values. So the difference here is what, $300K? So you're going to be taxed at a maximum of 1.25% of that, because the assessor is not going to get there in time, or not going to get there out there to assess it to include in your monthly mortgage payment. So they're going to send you that one bill. It's called a supplemental bill. That you must pay. I had a client that I swore I gave this information to, and they did not pay the supplemental bill, and now they owe $8,300 to that. And it's been a number of years, 4 or 5 years, and they haven't paid that supplemental bill, and it included some late payments and fees. So that is the supplemental bill. So guys, it's been great having you here today, here on Instagram, there on YouTube, Facebook, etc. Okay, is it my fiber optic to go? So it's been great having you guys here. If you have any questions, feel free to reach out to me. My number is flashing across the screen. Let me know if I could be any assistance to you. I love to reach out. I love to talk to you. 323-228-2736. 323-228-2736. Let me know if I can help. All right, guys. Talk to you soon. Bye-bye.